Hello everyone, and welcome to this presentation of a powerful strategy for capturing trendy markets. Welcome, my name is Primo, and today I'm going to be sharing with you how you could have purchased a stock like this. Now, as you can see here, we had a really nice upward move in this particular issue, and then a nice pullback, and this would have been the opportune place to purchase before we had the next big run. Well, I'm going to show you exactly how you could have taken advantage of that and exactly where to pinpoint your entries, such as this one. Welcome once again. My name is Primo, president and founder of Specialist Trading. And being that most of you are probably new to our website, just to let you know, we are first and foremost an educational company. We're a little bit different from most educational websites in that we really try to not just force feed you signals and tell you what the best market is and what the best time frame is, but we want to give you the information so that you can ultimately take your own cues. In other words, make your own trading decisions. It's our philosophy and belief at Specialist Trading that the reason why most traders fail is because you're basically relying on someone or something else to tell you what to do. In fact, just take a second to look at your own trading. How do you take your signals? Do you listen to some guy on TV telling you what he thinks the market should do or what the best stock is or issue is? Do you look at tons of indicators and you can't make a decision until they tell you or they all cross together? Or are you waiting with bated breath on every news announcement, and that will tell you what to do once the news comes out? This is the way most traders trade, myself included. And it's our opinion that this is the reason why most traders fail, is because you're basically taking yourself out of the game. Now, I've been trading for nearly 40 years. I started trading on the floor of the Pacific Stock Exchange. I was on the floor for 16 years, and 9 of those years I was a specialist. A specialist is simply a trader who made markets in roughly about 50 stocks. So if you wanted to purchase or sell a particular equity, you had to go to the person who specialized in that. That's what I did. And I traded through the crash of 1987 and the bull market that followed. So I've been in just about every market environment imaginable. I've traded through straight up, straight down markets, quiet markets. I know what works in terms of consistency and I know what doesn't. Therefore, this is what I teach and mentor all of my students, all the things that I've accumulated in my nearly 4-decade career, and the things that I currently use in my own personal trading as well. So this is what we are. We are an educational company. And as you'll see today, I'm going to educate you by giving you a strategy that you can actually begin using as soon as tomorrow if you'd like. And these are going to be the entry rules for this particular technique. And you start to see how we educate you to try and turn your trading around. But before we begin, we are required to show you our disclaimer. So please take a moment to look at it. I'm going to show you a lot of performance results using this particular trend capturing strategy, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. So as you're taking a moment to view our disclaimer, I would also like to take this time to invite each and every one of you to follow us on Twitter. You may want to copy our handle right there at SPCLSTTRADG. Each day I post new free information anywhere from daily financial wisdom, little tidbits I've accumulated along the way, to actual signals that our strategies have generated. So lots of great free information, although it is rather limited because of the way Twitter is formatted. So if you'd like to get more detailed information, such as some educational videos and more information about myself, my sister site, which is Pro Trader Strategies, has put together a Facebook page. So simply log on to Facebook, go to protraderstrategies.com, and there's a lot more detailed information about myself and what we do. Now, as I stated, we are first and foremost an educational company because it's our belief the reason why the majority of traders fail, upwards of 80%, is because you are relying on someone or something to tell you how to trade, to tell you what to do. So what we do at Specialist Trading, as you see here, is to teach you, not to simply trade for you the way so many other websites do, where they basically tell you on a nightly basis, buy this, sell this, this is the perfect time frame, this is the perfect market, this is the perfect contract. We don't believe in that. What we do is we supply you with the tools and information and the knowledge you need. We work and mentor with you. I personally mentor with all of my students. And then we basically define some type of method that best suits your needs. So that's my goal, to teach you how to trade with a specialist edge. This is the same edge that was able to turn my trading around. I struggled my first 2 years of trading. And because my mentors were able to teach me this edge of really becoming a part of the process and making my own decisions, I believe that is really what has sustained me for nearly 40 years. So hopefully, with all the information we provide for you in our courses, we'll be able to sustain you so that you can be trading 20, 30, 40 years down the road. Now, one thing I want to mention before we go into today's presentation, that since we are an educational company, this will be presented as a class. So if you happen to have any questions, kindly wait till the end of the presentation to ask them. Okay, I won't be answering anything till we get to the very end of the presentation. And many times, if you wait for the next slide, the presentation, or I should say the question, should be answered. So kindly wait. The only question I will answer is the most popular, and is this being recorded? Yes, it is. So if you happen to leave early, or if you're having technical difficulties, you can go to Pro Trader Strategies and they will send you a link to this recording. Okay, so let's begin. And I want to start out by talking about trading strategy number 1. Okay, this is probably one of our best pullback strategies, and we are giving you the entry rules, the initial entry rules for it today. Okay, this is a great strategy. You'll be able to, if you've been trading for some time, you'll be able to figure out where you'd like to place your stop, how much you want to risk, and where you'd like to exit. But we're going to give you the basic entry rules and show you the basis for its foundation. Let's talk about some of the highlights of this particular strategy. Virtually trades anything from stocks, EMini futures to the Forex markets. And we know it trades other markets as well. We have some students that are in India, some in Australia, in Europe that are trading those markets, and they've all reported consistency with the same method. Okay, it's a very consistent pullback method. So basically, we're looking for a trend to be established, and then we're looking for a little sell-off in price if the trend is up, and we're going to purchase at inexpensive prices. Or if the trend is down, we're looking for a little rise in price, a bounce, and we're going to sell into that bounce. Once again, this works in any market, any time frame or direction. If you are day trading, if you like to intraday trade, you'll get anywhere from 1 to 3 trades per day, depending on the market conditions. And if you're position trading, holding this position overnight, you'll get anywhere from 2, possibly even 3 trades per week, okay? As with all of our methods, we always ask our students to learn the strategy first. I know your eyes will light up after you see the rules to this for your entry, but please paper trade first. There's so much more you'll learn, and you'll probably save yourself a lot of money just by going through the practice, okay? Our edge here is consistency. I don't, by any means tell all our students that every trade is a winner, but that's perfectly normal. It's not about having every trade a winner the way so many websites proclaim. It's more about a 2 steps forward, 1 step back approach. So we're looking for, every once in a while we'll have some small minor losses, but we're looking for the resiliency in the method to be able to bounce back and quickly make up and recoup those losses. So all of our methods and courses are very consistent in their edge. All right, so these are the indicators that you will be applying in this particular strategy. 2 of them, and they're very simple. The 50-period simple moving average. And remember, it does not matter whether you trade tick charts or whether you trade monthly bars. You'll always have a 50-period moving average of that time frame plotted, and the 21-period Donchian channels. Now, they are a very popular indicator. You can find them just about on any charting software. If your charting software package doesn't provide them, ask them. They may be able to have them for you on file, or there are a number of free websites. I believe freestockcharts.com offers them. Just do a Google search and you should be able to find them. Now, these are the rules. I'm going to go over them rather quickly, but don't worry. Once again, this is being recorded, so you can request a link to this recording if you would like. So don't worry if you don't write it all down or don't understand it. I'm going to show you a lot of slides as well after this in all markets and time frames. All right, so these are the rules to enter if we are going long. First of all, rule number 1, price must be above the 50. Okay, now we can oscillate with the price bar being above and below the 50 period, but our entry has to be above the 50 period moving average. Now what we want to do is see all 3 Donchian channels headed in the same upward direction. Now they're not going to be in sync because that's the way they're formatted, but I'll show you in just a few minutes. They have this kind of stair-step approach. So we all want to see them in the same direction, headed in the same direction. Now here's where it gets a little complicated, but once I show you the slides, you'll be able to see it, how much easier it is. But we're going to look to buy when a declining price bar, this is the pullback, when price is declining, when its range is either touching or entirely below the middle Donchian channel. Okay, so we want to see price come down and touch that middle channel or at least go below it. This is going to be our setup bar. Okay, now that we've identified the setup bar, we're going to buy 1 tick above the high of that setup bar, but it has to be on the next bar. Okay, and once again, you'll see a number of slides, and it'll be a lot easier to understand. As always, paper trade before applying real funds. This is the basic initial entry process, but paper trade to see that you fully understand it. Let me show you what I mean here. This is the basic process, and I'm, specifically showing you generic charts without the time frames and without whatever market it is to show you that it doesn't really matter. We're more interested in understanding the process at this point. All right, so we have a blank generic chart here. Remember, it doesn't matter what market or time frame. First thing we do is apply a 50-period moving average, okay? And so we see here that price is above the 50 period. So we're basically looking to go long. We're looking for a pullback to the downside. Now, if we look at this chart now and we say, well, okay, so we're looking to go long, this would have been the most opportune place to buy, right? On that little sell-off in price when it started to rally here, but then sold off and rested before it resumed going higher. So how could we have taken advantage and purchased down here? Well, simple. We add the Donchian channels. There are 3 different channels. You see how they have this type of stair-step approach? Now remember, they're not all going to be in sync. Sometimes you will see bars such as this top channel going completely sideways, while the bottom 2 are still in this upward stair-step approach. That's okay, as long as they're still all headed in an upward direction. You see that this sideways bar, this horizontal bar, had come from a lower bar prior to that. So it was a higher step. As long as they're all in sync going higher, this is what we're looking for, okay? All right, so now what we want to see is price start to rise, and it doesn't have to, it's not a requirement, but many times it will touch that top Donchian channel, and then it starts to decline, as we see here. Now the first bar that touches this middle line, that's a setup bar. And we're going to buy if we trade above there. But it has to be on the next bar. Okay, so let's see what the next bar did. Well, the next bar never traded that high. So do we just walk away and say, okay, well, I guess there's no setup? No, because we're still above the 50 period. The Donchian channel bars are still in a stair-step fashion rising. And this touched the middle line. So this is now the setup bar. And we're going to buy if we trade above there. And so on. We continue to track it as long as all the requirements are in place until we ultimately buy, or else the requirements are out of place and there's no signal. In other words, maybe these start to go lower, or maybe they're not in sync with each other. But being that they are still ascending and we're above the 50, this is our entry, okay? And price continues its upward move. See how simple this is? We don't have to wait for news. We don't have to wait for some television guru to tell us when to buy or place a limit and hope and pray that it stops. We're simply waiting for price to trade above the setup bar's high. All right, that's the basic buy process. Let's go over the sell rules, which are basically the same thing. We're just going to reverse them. Now price must be below the 50 period. Once again, it's okay if price oscillates below and above the 50. We just have to enter below the 50 in order to go short. Now all 3 Donchian channels must be headed in the same stair-step downward direction. We're going to look to sell when price stops declining and starts to rise. So we're going to see a rising price bar's range either touch or be entirely above that middle Donchian channel. This will now be our setup bar. We're going to sell 1 tick below the low of the setup bar, okay? Remember to always paper trade though. All right, so looking at this generic chart, once again, we're not divulging what it is or what time frame because it doesn't matter. We're more concerned about having you understand the process. We apply the 50 and we see that, well, the majority price is below the 50. So this means we are only going to be sellers. We will never enter below the 50, and we will never sell above the 50. But since price is below the 50, what does that mean? It means we're sellers. So right off the bat, we've already eliminated half our losers because we're on the right side of the market. Now looking at this chart, we see that it started to go sideways, then had a nice rally, but then headed much, much lower. So obviously, if we're sellers, this would have been the best place to sell right here, okay? So how could we have taken advantage of that? Well, we add the Donchian channels. We see now that they're all headed in the same stair-step downward approach. Once again, while some are just going sideways, The others are headed lower, and they're not all going to be in sync. But as long as they are a lower step from the previous, that's okay. They're all in the same stair-step downward approach. So we see that they're all in sync in terms of their movement to the downside, not in terms of the actual channels. And price is heading lower, but now it touches this bottom and starts to rally. All right, price starts to increase. The very first bar that touches that middle line is a setup bar. And we're going to sell if we trade below it on the next bar. Well, here's the next bar. Did we trade below there? No. So there's no trade. But we're still below the 50. The Donchians are still headed lower. And this is above the setup bar. That's okay. So now this is our valid setup bar. And we're going to sell short if we trade below here on the next bar. And did we trade below there? Well, we sure did. So we entered to go short, and look what happened. Once again, you see how simple this is. All we're doing is being in sync with the trend, and we're using the Donchian channels to tell us when the pullback has concluded. That's how we find our setup bar. Okay, so let's look at some examples now. You understand the process. Now let's look at some actual real world examples in all the markets and in all the time frames. Once again, if you have a question, we will get to it at the very end. If you happen to join us late, we won't be taking any questions till the very end of the presentation. Okay, so let's look at stocks for all you stock traders. Let's look at SHW. This is coming into March. In fact, this was just a recent chart up until the last few days here in March. Obviously, we're going higher, but how did we know we were going to go higher? Well, the first thing you do is we see we would like to have purchased right here, so we add the 50-period moving average. And right at this point, roughly about mid-February, we started to have consecutive closes above, okay? So this tells us we knew as far back as the end of February that we're only going to be buyers, all right, because price was above the 50. Now we add the Donchian channels, and we see they're all in the same stair-step upward approach. So price rallies, touches the top Donchian channel. Now we need it to touch this red middle line, okay? So as it descends, it gets close to it, but it doesn't touch. It bounces again. And on this bar right here, it touches the middle line. So that is our setup bar on the 24th. So we would have entered the next day once it traded above on the 25th. And look what happened. You could have purchased roughly around 260 and the stock went up to roughly 290, almost 30 points in the next month. Now, once again, we realize this is a very expensive stock. That's okay. You could, instead of buying the stock, you could have just purchased options. Okay, you could purchase a long directional call or some type of long option strategy. It's up to you. How about SWKS? Now, obviously, if we think this market is going down, well, wouldn't we want to sell here? Well, we just want to confirm that we are going down. So where is price in relation to the 50-period moving average? Well, it's below. So obviously we want to sell. So let's add the Donchian channels. Once again, we see that the top one is headed lower. So is the middle, and so is the bottom. So as price started to rise, we want it to touch the middle line. And here's the first time it touched, right here. This was our very first setup bar. And we could go short if we traded below this on this bar. But did we ever trade below there? No, we did not. So now this is no longer valid setup bar, but this one is, because we're still below the 50. The Donchians are still headed lower. And so now this is a valid setup bar. And this was generated on the 1st of February. We could go short if we trade below it on the next day, which we did. And you could have gone short roughly around 67, and the stock went down roughly about 12 points in the next couple of weeks. I know a lot of people are just, glued to making their decisions off of news or off of tons of indicators or off of what someone is saying in a chat room or a trading room. But do you see now, if you have this information in front of you, you do not need to rely on that. There is no way that is going to make you more consistent, because you're basically taking yourself out of the game. But once you know the simple process, you're putting yourself back in and you are in charge of your own destiny. That is how one becomes a consistent trader. Not by listening to others or indicators or news events, but by making your own decision based off tools that have stood the test of time. Let's look at PG, okay? Now looking at this, someone would say, well, boy, Steve, there's really no direction here. We're just in a rangy market. We're going up, back down, back up, back down, and this is a recent chart coming into this week in March. Well, that's not the way we determine what the trend is. We apply the 50-period moving average, and we ask ourselves, where is price in relation to the 50-period? Well, price is above. So are we going to be sellers? No, because the overall trend is up, so we're only going to be buyers. So this isn't just a rangy market. This is giving us opportunities to buy. So wouldn't we like to buy at these places right here, these little sell-offs? These, looking in hindsight, would have been the best places to purchase before the price went up, okay? So I'm going to show you how you can use this same technique for swing trading, for quick in and out trades. Rather than trying to hold for the long trend, maybe you can just get in and out after a couple of days. How could we have done this in this type of scenario? Well, once again, we add the 3-period, or I should say the 21-period, 3 Donchian channels. Remember, these are set at 21-period or 21-day Donchian channels, depending on what your software labels it. We see that the bottom line, the middle line, and the top line are all headed higher. Even though they're not in sync, they're still all headed higher. So this is good. We wait for price to sell off and touch the middle line here. Unfortunately, it never got that low. So this wasn't any type of buy scenario. Now, the second time, it did. We touched the median line right here. So this is a valid setup. But did we trade above that setup bar on the next bar? No, we didn't. But now this is the valid setup. Okay, and this was generated on the 1st of March. Did we trade above there on the next day? Yes, we did. You could have gone long roughly about 81.5 and exited about 2 points higher in a couple of days. Now price begins to descend again. It creates another valid setup bar here, but no trade. Another valid setup bar here, but no trade. Another valid setup bar here, and this one was valid on the 15th, just last week, because the very next day it did trade above. You could have entered once again around 81.5 and taken another couple of points. So it all depends on what type of trade you want to be in. And once again, this is your decision. You can get in and out of these trades rather quickly, or you can try and stay in for the long haul. It's up to you. Now, I know a lot of people say, well, Steve, listen, this is all well and good, but, news, you can't ever factor in news because, you can be on the wrong side. The news will really take you out of the game a lot. I'm not going to sit here and tell you that that's not true. That may happen, but we have seen that our, very consistent tools and methods are often in front of the news. In other words, they will often get you in a trade prior to a news event, and oftentimes you will be on the right side. Let me show you an example here of something that was reported in eBay on January 27th. This was a few months ago, okay? eBay's disappointing forecast fuels a stock decline, okay? Weaker than expected revenue and profits for the current quarter and full year as the e-commerce company struggles against a strong dollar while trying to revamp its core marketplace business, okay? Shares of the retailer fell more than 12% to 23.5 and extended trading on Wednesday. All right, so bad news. The stock fell, I believe, after hours on Wednesday, the January 27th or so. Let's look at the stock first of all before that news came out. This is the way most traders trade. They say, well, Steve, in my chat room, we looked at the stock. Basically, it's in a range. It's not headed in any direction. It's going down then back up. So I'll stay away from this. There's really nothing to tell. There's no news on it. And we're just waiting for the earnings, okay? Let's apply our first rule, the 50-period moving average. Where is price in relation to this 50-period moving average? Price is below. So are we going to be buyers of eBay? Were we ever going to be buyers of eBay? No. Looking back all the way to the beginning of January, probably in December as well, we were below the 50-period moving average. So there was no reason you would have gotten hurt by bad news because right off the bat, you're not a buyer. You would never be holding on to something that is below its 50-period moving average. So we've been looking to sell eBay prior to the news. And how could we have sold it? We add the 21-day Donchian channel or the 21-period Donchian channel. Are they all in sync? They sure are. They're all headed in the same stair-step downward direction. So as we look here, we see that price was hugging the lower Donchian channel and then started to bounce. And on this day, it touched the median line. So this was a valid setup bar, but we never traded below it on the next day. We got just about there, but we never traded below it. So now this is a valid setup bar. Did we trade below it on the next day? No, we didn't. But this is still a valid setup bar. And guess what? We generated a sell signal on the 26th, the day before the news came out. And I believe even prior to the news coming out, you would have gotten short right here, roughly around $26, okay? Now, we didn't close below there, but then the news came out after market, and we all know what happened after that. So what I'm trying to tell you is that if you take your cue from news or from outside sources, most of the time you're not going to be consistent because you're a day late and a dollar short. The market, it's been my experience in nearly 40 years of trading that the market tells you everything you need to know. You just have to know how to listen to it by adding a few simple tools that are basically translating what the market wants to do. The first tool is the 50-period moving average. That pretty much tells you the overall direction of the market. So right off the bat, even if you didn't apply the dodging channels, if you're accustomed to that 50-period moving average, you wouldn't have even been long eBay. So there's no reason you would have gotten hurt. You would have been, if you were an aggressive trader, you would have been looking to go short. So by simply applying the 21-period dodging channels, that got you short well before the news came out. Now, a lot of you are saying, well, Steve, that's great, but how about intraday? I don't trade daily bars or weekly bars of stock. I trade intraday. Okay, well, we're looking at MNST, Monster. This is a 15-minute time frame, all right? We have the same 21-period dodging channel, the same 50-period moving average, and these are all valid buy setups on a 15-minute time frame, okay? You think you could have done well just trading this intraday? Now, we're not going to just stop there. Remember the opening chart I shared with you saying how you could have purchased down here at these levels? Well, that was a monthly chart of Apple, all right, going back to 2012. Now, as we see here, this would have been circled in green, the opportune place to purchase. But how could we have taken advantage of that? How could we have known to purchase it on the week ending April 30th, 2013, just about 3 years ago, okay? Well, all you had to do is apply the dodging channel, the 21-day dodging channel. We're using the exact same technique that I just taught you, all right? Price is hugging the top line and then starts to sell off. Once it touches the median line, those are valid setup bars. But we can only go long once we trade above these. And we haven't traded above each consecutive one until right here. So you would have basically entered around 65 and the stock basically doubled in value in the next couple of years, okay? Now, so you had anywhere in the world you could have exited. You could have taken a 2-point gain if you wanted to. You could have taken a 60-point gain if you wanted. It's up to you. Remember, you're in charge of your trading, not someone else. Now, let me show you what happened just about a year ago, last July, all right? So price is at these higher levels and then starts to sell off, okay, coming into this year. As we see, in July of last year, we had a major sell-off, and it touched the middle line. We are still above the 50 period. The dodging channels are still rising. So therefore, this is a valid setup bar. But we never traded above there on the next bar. Now, in order for these to be valid setup bars, they would have had to touch the median line, but they never did. The very first bar that touched the median line was here. I believe this was December of 2015, just about 3 months ago. So this is a valid setup bar below the middle line. But we didn't trade above. Then guess what? On the 29th of February, here was another valid setup bar. And if you're trading this on a monthly basis, you would now be long Apple. So this is something you may be wanting to watch just to see how far. Because right now, according to this technique, you should be long Apple on a monthly time frame. Okay, so for you long-term investors, you should be long Apple. Forget about what the earnings are. We don't look at earnings. We don't care about that information. Forget about the company. Forget about what new product is coming out. Forget about what some guy's saying on TV or in a chat room. We don't care about outside noise. The only thing we look at and take our cue from is from the chart in front of us, okay? Is this guaranteed to be a winner? No, but we're just telling you that most likely we would have been long right around par or 100. All right, now this also works on ETFs. Here is a daily chart of the spiders. So you could have used this not basically to trade the spiders because we know it's an expensive $200 stock, but you could have used it as a directional tool. Now here we have price on the 2nd of February, just about a month or so ago, below the 50 period. So we know that we're going to be short the market. The dodging channels are all headed lower. So we waited for price to bounce up. And once we touched on the 2nd, this created a valid setup bar, where we could have gone short roughly about 192 or so. And Look what happened in the next couple of weeks. All right, that transferred to a 800-point downward swing in the Dow. So even if you're not trading the stock, if you're not trading the spiders, you could have used this as a market directional tool to tell you what direction you think the market is going, because the spiders basically represent the S&P 500 index. How about 10-year notes? Okay, here's a weekly chart of the 10-year notes going back to November of last year. All right. Now here's a little bit more advanced trade because price is oscillating above and below the 50 period, but all the Donchians are still headed higher. And when we see price coming down, we created our first setup bar here, and then we never went above it, but our second did on the 13th of November, and that is where you would have been long the 10-year notes. And look what happened. Not much happened right off the beginning, but ultimately coming into this year, you see what happened to the 10-year bonds, okay? Doesn't stop there. How about gold? Everyone has been surprised and really fascinated how gold just took off at the very beginning of the year, okay? Well, we're not. Once again, we're not looking at fundamental news. We're not looking at what some gold bug is talking about. All you had to do was use this simple technique. Here's a daily chart of gold, of the gold future, okay? We see here that coming into the new year, as you see, this is the beginning of 2016, price was below the 50. So we were still looking to short gold. But now the very first week, we had consecutive closes above the 50 period. So this is telling us now the overall trend is up. But we have to have some more structure, so we apply the Donchian channels. We see that the bottom line went up, the middle line is ascending, and so is the top line. So now we have confirmation that we have an upward trend. We want to see price begin to sell off, and once it touches that middle line, that's our setup bar. But on this day here, I believe it was the 15th, we never traded above. But now this is our valid setup bar. If we trade above there, we will enter it. And guess what? On the 14th, that was our valid setup bar. So we entered long on the 15th. And you all know what's happened to gold in the past couple of months here, okay? Remember, we did not have to look at anything fundamental. We did not have to look at, what's going on in the world or what people think of the market. Everything you need to know is in front of you in the chart. So why overcomplicate your trading, and why try to make it so, so difficult to decipher what it's trying to say by interpreting news, by making it, too subjective. Keep things cut and dry by just adding a few simple tools that have worked and stood the test of time, and trading is a lot easier. Plus, you don't have to spend so much time and money figuring things out. This can also work on crude oil, okay? Crude oil has been going lower, although since February it has been bouncing, okay? Now, if you look at this weekly chart, you see here that we've been getting nothing but sell signals the entire time, all right? These are all using the same strategy entry technique I've taught you this past couple of minutes here. Same thing. We touch the middle line and we go short on the next bar. Now, guess what? This is a current weekly chart coming into this week. This is what happened last week, okay? Now, this is the bar of this last current week. Now, if we trade below this, we will be getting short crude oil again. I know a lot of people look at news and they say, hey, well, oil must have made a bottom, so you have to buy it. But on a weekly time frame, it's not telling us that we're going long yet because we're still below the 50-period moving average. So we are in no way on this time frame going to be buying crude oil. And actually, we're looking to go short. So this is something you may want to track yourself. Do we have a signal yet? No, we have a setup, but we do not have a valid signal yet to go short. All right, so that was commodities, futures, and stock market. I'm sorry, commodities, ETFs, and stock market. Let's look at futures now. Let's look at the EMini S&P futures. Here's a weekly chart of the EMini. Once again, it represents the S&P 500. We're looking back to April, roughly, of 2012, okay? The same techniques applied. We're above the 50-period moving average. Every time price came back and bounced and touched that middle line, look at all the buy signals that were given coming into 2015. Now that's a weekly chart just for educational purposes to show you how this works. Let's look at a 60-minute chart. This was on the 16th, just a few weeks ago. As we see here, we're above the 50-period moving average. Even though they're out of sync, we have upward moving, upward moving, upward moving. So they're still in the same direction. So we want to see price come down and touch that middle red line. It doesn't do it until right here. So this is our valid signal to go long. You could have entered roughly about 2007, and the stock went up roughly about 40 points in the next 2 days. Okay, this was on an hourly chart of the E-mini. Now I want to show you this because this is a much older chart. This is going back years, but this is a 5-minute chart of the E-mini, and I'm showing you this for a specific reason. If some of you are new to trading, you may not remember this, but a few years back we had something called the flash crash. A lot of traders complained saying that, you know, boy, there's no way a small trader like myself can make money, because when these institutions put together these high frequency systems and trading platforms, there's no way little guys like us can take advantage, where the markets will fall out of bed thousands of points. We can't compete with that. Well, first of all, you're not competing with anything. As a trader, you have to get that mindset out of your mind. No one is competing with anything. Just the way you're not competing with someone else when you're taking a breath, you know. Everyone is exhaling and inhaling at the same time, just the same way everyone is buying and selling at the same time. But when you breathe, you're not competing with someone else taking a breath. It's the same way. You should have the same mindset when you're trading. The only thing you are trying to do as a trader is to figure out what the market wants to do and then simply jump on board. So we're giving you the tools to figure out what the market wants to do. If we look at this 5-minute chart here of the E-mini, we see here that price was below the 50-period moving average. So right off the bat, we know we're not going to be long on a 5-minute time frame. Why? Because the overall trend is down, and the market is telling us most likely it's going lower. Then we apply the Donchian channels. We see that they're all headed in the same stair-step lower progression. So we simply wait for the same pattern to apply. We hit the middle channel. Okay, we didn't trade below it. We now have another setup bar. We didn't trade below it. We now have another setup bar, and we did trade below it on this particular bar here. All right, so we're now short the E-mini. There's no way you can be a victim and say that these high frequency programs are taking you out of the game, because you're now short before this happened. Okay, this is the flash crash, May 2010, roughly about 6 years ago. So don't become a victim. The way you become a victim is on relying on outside sources to tell you what to do. Once you take charge of your own trading, you can't blame anyone else. Take responsibility, and that's how you become consistent. All right, now finally, let's look at the Forex markets. For all you Forex traders out there, we're not going to change anything. Even though we're looking at an entirely different market, entirely different time frames, we're not changing one single rule that I've explained to you today. Here's a weekly chart of the Canadian dollar, okay? Price is above the 50 this entire time on a weekly basis, going back a couple of years. And we simply wait for the same process. We wait for a price bar to touch the rising middle line, and that's our setup bar until we trade above it. And there we have 2 entries. Okay, you think you would have liked to gone long the Canadian dollar back roughly about a year ago and captured all of this movement up? Now you can use this on daily bars as well. This is a current chart of the British pound. Looking back in November of last year, price is below the 50 period. So even though right now, coming into March, here's where price is in the British pound, we knew 3 or 4 months earlier that we're not going to be buyers. Why? Because we applied the 50-period moving average and price is below. So why would you buy if you're below the 50-period moving average? Okay. So now once we have that, we add the Donchian channels, and they're now all descending. So we simply wait for price to touch that middle line, and that's our signal to go short. And here's another setup. Actually, there's another setup right here. That one would have been stopped out, or you could have taken a quick profit and then got back in and recouped the losses. Got back in again, short here, coming into the beginning of March. Okay? So let's recap before we go into question and answer portion. Remember, this technique trades stocks, futures, Forex markets, any time frame, any direction. Okay? It's probably our most consistent pullback strategy to date. Remember, it's not a breakout strategy. A breakout waits for us to establish some type of top or bottom, and we wait to break out above or below that. Pullbacks are entirely different. If we're in an uptrend, being above the 50 period, we wait for price to sell off. This is how we buy on the pulling back of price. We buy at less price, at much lesser prices. Now, conversely, if we're below the 50-period moving average, we wait for price to rally, to bounce, and we get to sell at higher prices, okay? Remember, if you're day trading this technique, you'll get about 1 to 3 trades per day, depending on the volatility environment. If you're position trading, meaning you hold positions overnight, you'll get a couple of trades per week. As always, even if you're a member of our course, if you purchase our courses, we just gave you this for free, but even the people who pay for our courses, we always instruct them to paper trade first. I know your eyes are probably lighting up. You're probably looking where to find the dodging channels. You're applying this to current trades you may have had, and you're seeing how well it works. But please, inevitably, most traders will fail right off the bat because they jump in too soon. You have to really understand the process of this, understand how it, how the dodging channels appear in real time, how the 50-period moving averages in real time. So paper trade it. Maybe a couple of days, a couple of weeks, a couple of months. It absolutely makes no difference until you feel totally comfortable. Our edge here is consistency. Remember, I showed you a few trades where there were small losses, but then I showed you how easily those losses were recouped. So it's about 2 steps forward, 1 step back. Every once in a while, we will have small minor losses, but we have tremendous belief in the consistency in all of our methods. Now, as we close here, I want you to ask yourself something. Let me ask you a question. Do you think this strategy could have helped your trading this past year? In fact, go back and look at your last 10 or 20 trades. Do you think any of the techniques I gave you could have helped your trading? What about if you just said, well, Steve, you know what? I'm not really an indicator trader. I don't like to do this. I can't cut the umbilical cord with news. I've just been taught and I feel too comfortable using news. Okay, listen, I'm not going to tell anyone to trade that this is the right way or this is the wrong way and you must trade this way, because once again, that goes against our entire philosophy. But what if you just applied the 50-period moving average to your own technique, all right? I can almost guarantee that if you look back at your last 10 or 20 trades, the majority of your losses were because you were buying below the 50-period moving average and selling above. So if you just use that simple technique that I gave you today, I really think you can increase your odds for success. Now, what if I could offer you 3, 4, maybe 5 more high probability edges that are just like what I shared with you today, but entirely different edges? Well, this is what we're offering today for all of our attendees. This is our special attendee discount just for attending today's presentation. This is our Secrets of a Stock Exchange Specialist training sessions. And what this is 3 hours of trading techniques plus a full strategy. In other words, we're giving you all the complete rules to the strategy I just shared with you, strategy number 1. About 3 years ago, I was asked to speak. I was asked to be the head speaker at a conference in Denver, Colorado. I spoke in front of a large group of people, and I spoke for 3 hours, and they videotaped the entire session. That's what this is. This is a video seminar, and we give you the link to this, so you can watch this at your leisure time, whenever you'd like to, and it's yours to keep, okay? In the 3-hour presentation, I talk about many more high probability trading edges to use and apply to your trading. I go into detail about which indicators not to use, plus the #1 chart pattern you should be looking for in virtually any strategy. And in this 3-hour video, I give you the complete rules to strategy number 1. Now today, all I did was share with you the entry. I didn't talk about where to exit. I didn't talk about where to place your stop. I didn't talk about how to track the trade if you wanted to squeeze more profits. I didn't talk about where and when to raise your stop to unchanged. All this is included in this 3-hour Secrets of a Stock Exchange Specialist video seminar. Okay, 3 hours of trading techniques plus the complete rules and the full rules to the strategy I just shared with you. Now, my sister site, Pro Trader Strategies, has this entire Secrets of a Stock Exchange Specialist video seminar marketed for nearly $1,000. That's how powerful and valuable it is. There's so much information. But because of all the attendees taking time out of your day to come join us, we are dropping the price, if you can believe this, down to $37. So for only $37, probably less than you spent today trading for your commission costs. For $37, you get 3 hours of more high probability trading techniques, completely different from what I shared with you today, plus all of the rules to strategy number 1. Now today you just had the entry rules. In this entire 3-hour video, I tell you where to exit, I tell you where to place your stop, how to trade advanced, where you want to trade more aggressively, if you want to trade more conservatively. This is all included for $37, but it's only for a limited time. In fact, only for the next couple of days. So here's how to take advantage of this great discounted offer. Pro Trader Strategies is my sister site. They market and promote all of my courses. You can email them if you'd like. If you want to talk to one of their trading consultants, they're manning the phones right there. If you can call them at that number provided, or go directly to the link on the page at the very bottom. Now that is not a live link. What that is a something you have to copy and paste onto your browser. If you would like to go to a live link of this, all you have to do, if you look onto the right-hand column of the GoToWebinar page, you'll see in the chat box they have posted a live link where all you have to do is click that on, and we'll take you directly to the $37 sign-up page, okay? So I'm going to leave all this information up here. Remember, if you just want to go directly and spend $37 very quickly, because remember, this is only lasting for a couple of days, just simply click on the live link in the chat box to your right. Now, I want to thank you all for holding off on any questions. Let me open up the question and answer box. I will leave all this information up here, and let me answer any questions that you may have. Let's see, the first question is, how many days for the Donchian channels? Okay, I think what you're asking is, what is the setting, the daily setting? The Donchian channels, it should be set to a 21 period, okay? Now, some formats, it says 21 days. Some formats, it says 21 periods. Remember, all it is doing is looking back 21 periods of the particular time frame you're looking at, and that's how it comes up with its calculation. So we're not going to base it off of days. We're basing it off of the number of bars that you have in front of you. So if you're looking at 5-minute time frame, it's going to calculate back 21 5-minute bars. If you're looking at monthly bars, it's going to calculate based off 21 monthly bars. Okay? It's that simple. If your charting software doesn't have the Donchian channels, remember, just do a Google search. I believe a website entitled freestockcharts.com has it, and it's, as the title implies, it is free, and you can apply a 21 period Donchian channel there. Okay. John asks, does using multiple time frames on FX help? Okay, John, this is a very common technique, and I believe what he's stating is that many people like to look at different time frames in order to tell them what to do on the lower one. So in other words, if you like to trade, let's say, a 15-minute time frame, what you'll do is you'll look at a higher time, such as maybe possibly an hourly or even a daily, and wait to be all in sync with these higher time frames. Once your lower time frame is in sync with the higher time frame, the technique goes that you should have a higher probability for success. Now, it's been my experience, and I don't want to be negative, but it's been my experience in nearly 40 years that there is no consistency in applying this technique for virtually any market, any time frame, in any direction. I have found no consistency personally trading this. Trust me, I was taught this some 30 years ago on the floor. I tried it myself, and all it served to do was keep me out of a lot of good trades, because while I was waiting for all the time frames to line up in sync, I missed a ton of great trades. So when I trade, I only trade the chart in front of me. If I'm looking at a 5-minute chart of Forex markets, that's the only chart I'm concerned with. I'm not looking at what the hourly is doing. I don't care what the daily is doing. I don't care. I only trade the chart in front of me. Having said that, if you must feel that you just can't let go of that, you have to trade, that's fine, okay? There's no requirement, though, at specialist trading telling you that that is needed. I have found no consistency that way. But if you swear by it, then go ahead, okay? Next question. Let's see, my chart does not, the Donchian channels does not have a middle line. That's true. Many Donchian channels, for some reason, on different charting packages, do not have a middle line. Well, the middle line is simply a simple moving average, or is based off a moving average. So it's not, ideal, but you can substitute the middle line for a 21 period simple moving average, okay? And even though that will be a lot smoother, you won't have that kind of stair-step approach, you can still use a 21 period simple moving average as your middle line and use that to define where the setup bar is, okay? See, Tom says, could you give me the Donchian channel info as to where I can get it? Well, once again, the first thing I would do is check with your charting software package. Many charting softwares, you just look under the indicator page and you will find it there. If you do not find it, do a Google search just for Donchian channels and see if there are any free services that offer it. The one that I do know of, and we're not affiliated with them in any way, it's just some of our students and members have told me that it is offered here, is a website called freestockcharts.com, okay? freestockcharts.com. Simply go there or Google that, and I know that they do have the 21-period Dodging channels, all right? Bill asks, is there a way to handle failed trades or operator goofs? Well, when you say failed trades, the way to handle a failed trade by that is, I assume you mean a losing trade, is to have a technique that is consistent. And I just shared with you a very consistent technique. So that's the first step. You want to be involved in something that's consistent. Once again, I've told you the things that in my nearly 40 years of trading, I have found no consistency in. And I can label them right now. First, I have now no consistency in trading with news, looking at news events, because how many times have you looked at a news event and it appears to be very good news, and then whatever you're looking at, the stock or the market goes straight down? And vice versa. It's terrible news and it goes straight up. Now, oftentimes it will be in sync with the news, but there's no consistency with that. Remember, we want things that have a 2-step forward, 1-step back approach, not a, well, 1 step forward, then 3-step back approach, which I have found with news, I have found with volume, I have found with Fibonacci retracements level. They're too subjective. Looking at what the institutions are doing, it's too subjective. Okay, so support and resistance levels, once again, one trader's support is another trader's resistance. So we don't apply any of those things. Our techniques and methods at specialist trading are extremely simple. We don't try to use things that are that one trader will look at the chart and say, oh, well, that's a buy setup, and someone will say, oh, no, that's a sell setup. Those are subjective things, and that's why most of the time they're not very consistent. We want two traders to look at the same chart with our same methods and come up with the same scenario. Once you have that, then you know that you're looking at something that has a very cut and dry level of consistency to it. So that's, if you're asking how do you deal with failed trades, that's how you do it. You find methods and a mentor that has something that works over time. But basically, the main thing is you have to be in charge. I'm not going to sit here and tell you what to trade and how to trade it on an individual basis. I will teach you and mentor you, but ultimately you have to make that decision. You have to decide whether you want to trade intraday, whether you want to trade swing trading, how many lots you want to trade. Now, we give you all the information and the variables to decide from, but ultimately it's going to be your decision, okay? Why? Because that's the way, that's what turned my trading around. When I struggled my first 2 years of trading, I wanted my mentors to tell me what to trade. I used to say, tell me what stock you're buying and I'll buy that too. And they said, no, because you have to learn how to do this. What good would it help you? And it's true. Because of them teaching me that, I think that's what's been able to sustain me for nearly 40 years. Johan is asking, can you use the Bollinger Bands instead? No, Johan, you know what? A lot of traders like that, but they are a entirely different format, and I wouldn't really suggest it. We have a Bollinger Band strategy as well, where we apply the Bollinger Bands, but entirely different. So you may want to contact the people at Pro Trader Strategies. Maybe they can, if you're interested in trading with Bollinger Bands, talk to them. They're very knowledgeable. They can include you and share with you any insight we have with Bollinger Band trading. But this, if you're using this technique, no, it does not work well with Bollinger Bands, okay? Let me see if there are any more questions. Excuse me. Yeah, I see a lot of questions if people can substitute Bollinger Bands. No, because of the unique structure of the Dodging channels, I would not apply them. Now, one thing that a lot of students ask, they say, well, how about Keltner channels? I would say okay with Keltner channels. Even though they're not the same, they are similar, more similar to the Dodging channels than Bollinger Bands. So if you really feel that you want to substitute something and you don't have the capability to use Dodging channels, then I would use the Keltner channels, okay? They can be a fine substitute. Okay, well, I guess this brings us to about the end here. Most of the questions I've answered. And remember, if you want to take advantage of this $37 deal, this is not something that's going to last for the next 3 or 4 days or even a week. You have to take advantage in the next couple of days. So even though we will provide you with a link to this recording, don't take your time sitting on this offer, because trust me, that price will go back to $1,000 by the end of the week. $37. I don't even think you can go out to dinner for two for less than $100 these days. So trust me, this is a great, great deal. And we just want to get to know you. We want to, do this in good faith so that you'll be staying with us a long time. And then after you see that, we really want to teach you. We really want to mentor you so that you can be successful in terms of consistency. Perhaps you'll be a member of some of our other courses. So we're offering you something very inexpensive so that you'll be able to come on board with this, okay? Remember, contact Pro Trader Strategies. That is their email address and their phone number if you want to get more information, or simply click on the link, the live link in the chat box in the far right-hand corner of the GoToWebinar column there, and you can go to the sign-up page, okay? In conclusion, I want to say thank you so much for attending. I hope you got something out of this. I hope you see and get a little bit more insight into our philosophy at Specialist Trading, and I also look forward to all of you becoming students of mine and members of Specialist Trading. I want to thank you so much. I hope to see you next time. Bye-bye.